Disclaimer, this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, welcome back to The Explainer. Today, we're putting our equity research analyst hats on and taking a hard, objective look at Royalty Pharma. Now, if you've been skimming the financial news, you've definitely seen their shiny headline earnings for the second quarter of 2026. The PR is absolutely glowing, the stock has been hovering right near the top of its 52-week range, and they actually just raised their guidance for the second consecutive quarter. But as we know, the real story, it's never in the press release. It's buried deep in the footnotes of the financial statements. So let's peel back the layers and figure out the true mechanics of this business.
Here's our roadmap for the analysis. We'll start with BioNTech's cash machine, move into the Q2 2026 victory lap, look at how they're fueling their deal engine, dig into a major stock-based comp catch, and finish up by valuing the compounder.
Section 1. Biotech's hidden cash machine.
So, what makes Royalty Pharma so unique? Well, they don't actually develop drugs, they don't run incredibly risky clinical trials, and they don't hire absolute armies of sales reps. Instead, they just buy future royalty streams on approved or late-stage medicines and let the other pharma companies take on all the operational risk. Basically, they sit back, collect royalties, and print cash. And to really grasp the sheer scale of this operation, you just need to look at one number, $3.5 billion. That's the top end of their newly raised 2026 guidance for full-year receipts. We're talking up to $3.5 billion flowing through their doors this year alone. That is a massive river of cash, and it's exactly why we need to investigate how they generate and, more importantly, deploy every single dollar.
Before we get into the quarterly data, let's quickly demystify some of the jargon you're going to hear. The big one is portfolio receipts. All this means is the sum of their royalty receipts, literally the percentage of drug sales they collect, plus any milestone payments or contractual bonuses. Think of it as the core top-line cash flow generated from their basket of over 35 commercial therapies. This is the primary metric we'll be tracking today.
Let's jump into Section 2, Q2 2026, crushing the guidance.
Let's look at the actual Q2 data side by side with last year. Royalty receipts came in at $768 million, which is a really solid 14% year-over-year growth. Portfolio receipts grew 6% to $773 million. But check out that bottom metric. Net cash provided by operating activities literally doubled, up 100% year-over-year to $728 million. I mean, think about the math there. You bring in $773 million in receipts, and you generate $728 million in operating cash flow. That is a cash conversion margin of roughly 95%. Let me tell you, there are very, very few businesses on the planet that convert revenue to cash at that kind of rate.
So what's actually driving that double-digit growth? It's a handful of serious blockbuster therapies. Tremfya revenues shot up 53%. Voranigo up an unbelievable 72%. Evrysdi grew 42%. They're also getting great momentum from new approvals like Imdeltra. But we have to be objective here. It wasn't all sunshine and rainbows. They got hit hard on Promacta. Receipts there completely cratered, falling 75% because it lost exclusivity and generics flooded the US market. And you know, that's just the reality of the royalty model. Eventually, patents expire and the cash flow dries out.
Which brings us perfectly to Section 3, fueling the deal engine.
Listen, generating over $700 million in cash in a single quarter is amazing. But the real question is, what do management do with it? The defining theme for the first half of 2026 was pure discipline. They slashed their share buybacks down to $96 million. Now that might sound like a decent chunk of change, but keep in mind, in the first half of last year, they blew a whopping $1 billion on buybacks. Cutting that by 90% as the stock rallied up near $60 a share, that shows tremendous capital restraint. Instead, they took that cash and poured it into the core business. Capital deployed into new royalties surged 26% to $877 million. So the message is clear. Right now, they'd rather buy new assets than buy their own stock.
To see what that looks like in practice, check out their July acquisition. They bought a 3.75% worldwide royalty on AstraZeneca's drug Clarimediga for up to $425 million, including $125 million upfront. This is a potential first-in-class cardiovascular drug, going after a market that was valued at $7 billion last year. If it actually succeeds, AstraZeneca thinks it could hit peak annual sales of $3 to $5 billion. This is the exact playbook Royalty Pharma uses to replenish the pipeline when older drugs like Promacta start rolling off.
All right, Section 4, the stock-based comp catch. This is where we need to put on our investigative journalist hats. Take a look at this visual dissonance. The company loves to talk up its adjusted EBITDA, right? And for Q2, they reported a massive $736 million. But if you actually scroll down their 8K filing and look at the real GAAP net income attributable to the company, it was $18 million. That is a staggering plunge from over $700 million all the way down to $18 million. Total operating expenses exploded from $369 million a year ago to $541 million this quarter. So what exactly is eating up all that money?
Boom. $107 million. That is the amount of stock-based compensation expense they recorded in Q2 alone. If you annualize that, you're looking at over $420 million a year, which is roughly 13% of that highly touted adjusted EBITDA number. This all goes back to an internalization transaction they did last year. They essentially brought their management structure in-house and switched to a compensation model that leans extremely heavily on equity.
Independent analysts like the team over at Charged Alpha hit the nail on the head here. They pointed out, and I quote, "The headline metric does not contain an accrued compensation on the balance sheet. Part of that bill is being deferred, not avoided." The takeaway here is absolutely crucial. Yes, stock-based comp is a non-cash expense today, so it doesn't drag down that beautiful $728 million operating cash flow figure. But make no mistake, it is real dilution for shareholders tomorrow. If we're going to calculate the true intrinsic value of this business, we cannot ignore those deferred costs.
Let's wrap things up with Section 5, valuing the compounder.
So with the massive cash flows, the pipeline of acquisitions, and this hidden share-based compensation, how on earth do we price this thing? Well, one of our sources summed it up perfectly. This is not an income stock. It is a compounder. And a compounder has to be valued in two pieces. Think about it. Even with all that cash, the quarterly dividend is just 23.5 cents per share. At current prices, that's only a 1.6% yield. You are absolutely not buying this for the quarterly check. You're buying it for the compounding effect. To understand the valuation, you've got to split the business into two distinct buckets.
Here's the analytical framework. Bucket 1. You value the existing book, the royalties they already own, knowing they will eventually expire, plus the 19 development stage product candidates they have in the pipeline. Then, bucket 2, you have to separately and explicitly value the deal machine itself, the actual capital deployment engine that's going to go out and buy the next wave of royalties.
And when you do that math, you uncover a massive hurdle. Independent models show that if you take the recent stock price, around $56.77, and you subtract the value of the current book, the pipeline, the cash, the debt, and that accrued compensation we just talked about, you're left with a wild number. The market is effectively valuing the deal machine portion alone at over $14.2 billion. To justify that kind of premium, the math requires the company to deploy $3.4 billion into new deals every single year forever, while earning a 14% return. But let's look at the facts. Their historical best year ever was $2.6 billion, and in the first half of 2026, they've deployed $877 million. That is an incredibly demanding valuation hurdle.
Which leaves us with this final, provocative thought. Royalty Pharma is without a doubt a cash-printing machine today. The margins are brilliant, the portfolio is diversified, and those Q2 numbers were genuinely stellar. But the market has set a remarkably high bar for the future. Can this deal machine really deploy $3.4 billion a year, every single year, forever, just to justify its current price? The fundamentals are pointing one way, but that massive hurdle suggests a real challenge ahead. Which side are you on? Do your own homework. Thanks for joining me for this explainer, and I'll see you next time.